Welcome to the deep dive. That upcoming S&P 500 rebalance in September. It's way more than just a routine tweak. This is a really high-stakes event, you know? It impacts trillions of dollars, pension funds, maybe even your own investments. Okay, let's unpack this. Today we're diving deep into how the S&P 500 actually works, that famously secretive committee making the calls, and one company that's, well, frankly, fascinating and controversial, MicroStrategy. They're really testing the limits, asking what kind of company even belongs in this elite index anymore. It's a classic clash old rules, new economy.
Exactly. And what's fascinating here is seeing how these big market benchmarks, these things we rely on, how they actually adapt or struggle to adapt to really unconventional strategies. Our mission today really is to give you a shortcut to understanding these complex dynamics. Why does it matter? That's what we want to get at.
Absolutely. And MicroStrategy is like the perfect Bitcoin dilemma for the S&P 500 committee. Their whole business model has become so tied to crypto, which is, notoriously volatile. It forces some tough questions. By the end of this deep dive, you'll get the specific criteria for joining the index, the unique hurdles the committee faces with a company like this, and what it all might signal for the future of market indices and, how you think about market trends. Okay, so before we get into the weeds with MicroStrategy, let's just quickly level set on why the S&P 500 is such a big deal. It's really not just some number on the news ticker. It's the benchmark for the U.S. stock market.
Right. The preeminent one, really.
Yeah, it captures something like 80% of the total U.S. market cap. It's a huge gauge of economic health.
And its influence is massive.
Right.
Trillions of dollars in passive index funds, ETFs, they all track this index. So, yeah, changes matter. They ripple through almost everyone's portfolio.
So how does it actually work? You hear terms thrown around.
Right. The core methodology is free float adjusted, market cap weighted. Basically, a company's weight, its influence in the index, is based on the total market value of the shares that are actually available for public trading. It's not about the share price itself, but the overall size.
Free float adjusted, okay.
Exactly. Only publicly traded shares count. And this total market cap is divided by a special number, a proprietary index divisor. S&P Dow Jones Indices adjusts this divisor constantly, meticulously, to keep things smooth.
To avoid distortions from stock splits and things like that.
Precisely. It ensures continuity, so the index value reflects market movements, not just corporate actions.
Okay, makes sense. So with all that influence, who actually gets to decide who's in and who's out? And why all the secrecy around it?
Ah, yes, the secretive committee. That's a key difference for the S&P 500 compared to some other indices that might be purely rules-based, purely quantitative. Here, a committee makes the final call, and they have a degree of discretion. Their decisions aren't public until the official announcement.
Which feels a bit opaque.
It might seem that way, but it's actually a deliberate design feature. Think about it. If the inclusion criteria and timing were perfectly predictable, fully transparent.
Traders would try to game it.
Exactly. Sophisticated traders could front-run the changes for weeks, maybe longer. That would create extreme price swings and really disadvantage the passive investors who just have to track the index.
Right, they'd be forced to buy high or sell low just because of the rebalance.
Correct. So the committee's subjective oversight, plus that short window, usually just about 5 days between announcement and the change actually happening, helps mitigate that kind of manipulation. It's a balancing act between representation and, market stability.
Okay, that makes more sense. So what does it actually take to get on the committee's radar? What are these stringent criteria?
They are pretty tough, designed to ensure only the largest, most stable U.S. companies make the cut.
Let's tick through them. First up, size, market capitalization.
Yeah, and this isn't a fixed number. It's dynamic. It trends up with the market. For instance, the threshold for consideration around now, say July 1st, 2025, is expected to be around $22.7 billion.
$22.7 billion. Okay,
Yeah.
Substantial. What's next?
Profitability. This one's crucial.
Right, this seems like a big one.
It is. A company needs positive earnings, actual GAAP earnings in its most recent quarter. And the sum of its earnings over the previous 4 quarters also has to be positive.
So consistent profitability, not just a one-off good quarter.
Exactly. It's a key hurdle. Then there's liquidity and public float.
Meaning the stock trades easily.
Yes, highly liquid. The annual dollar value of shares traded needs to meet or exceed its market cap, and at least 10% of the company's shares must be available to the public. That's the public float part.
Okay. And location matters too, right?
Definitely. Domicile and exchange. Has to be a U.S. company, domiciled in the U.S., and trading on a major eligible exchange like the NYSE or NASDAQ.
And some structures just don't qualify.
Right. Things like SPACs, Master limited partnerships, LPs, business development companies, BDCs, they're generally ineligible, often because of their complex structures or different regulatory environments.
And there's a qualitative aspect, too, not just numbers.
Yes, a significant one, corporate governance. The committee prefers companies with structures that align with one share, one vote principles. They look at the overall governance setup.
Got it. So strict rules, but also some committee judgment.
Precisely. And the context for applying these rules is always shifting. Right now, heading into this potential September 2025 rebalance,
Yeah.
you've got this backdrop of, well, optimism about potential Fed rate cuts, decent corporate earnings.
Though driven by a few giants.
Absolutely.
Yeah.
The Magnificent Seven tech stocks are still carrying a lot of weight, making up maybe 35% of the index. It creates this high-pressure environment for companies like MicroStrategy that are really pushing the envelope on traditional business models.
Which brings us neatly to MicroStrategy itself. MSTR. People might know them from way back. Business intelligence software, right?
That was their origin, yes.
Mm-hmm.
But since August 2020, they've undergone this really fundamental transformation. It's become a totally unique case study.
Unique is one word for it.
Huh, yes. MicroStrategy has essentially morphed into a dedicated Bitcoin investment vehicle. It's widely seen as a de facto Bitcoin proxy now.
Meaning its stock price just follows Bitcoin.
Very closely, highly correlated.
Yeah.
And Bitcoin, as we know, is volatile. To put some numbers on it, by the end of 2024, they held, let me check the latest, 447,470 Bitcoins.
Wow.
Yeah, with a book value around $52.8 billion back then. And that represented something like 92.5% of their total assets. That massive strategic pivot is the story here when we talk about S&P 500 inclusion.
Okay, so given that radical shift, let's measure MSTR against those S&P criteria we just laid out. How does it stack up?
All right, let's do it.
Market cap. This seems like their strongest point. As of, say, early September 2025, their market cap is hovering around $96.87 billion.
Yeah, easily clears that $22.7 billion hurdle we mentioned, comfortably surpasses it. That's a big check mark.
Definitely their strongest argument. But then, profitability. This feels like the major sticking point.
It's a huge area of concern, yes. You mentioned the rule. Positive earnings last quarter and positive over the last 4.
Right. So how does MicroStrategy fare there, given its Bitcoin focus?
Well, not great historically. For example, they reported a pretty significant net loss in 2024, negative $1.167 billion.
Oof. Why is it so hard for them to show consistent profit?
It's directly tied to Bitcoin's price swings. Accounting rules, specifically GAAP rules, require them to record impairment charges when Bitcoin's price drops below what they bought it for, even if they haven't sold.
So paper losses hit the bottom line hard, even if the price recovers later.
Exactly. These impairment charges can wipe out operating profits, making it incredibly difficult to meet that consistent positive earnings requirement. Every dip in Bitcoin creates a drag on the reported profitability, which is precisely the kind of stability the S&P committee looks for.
Okay, so profitability is a major hurdle. That leads us to the broader business model and stability question. This must be the core dilemma for the committee, right?
I think it absolutely is the central factor, really.
How does their model, basically holding Bitcoin as a treasury asset, differ from other crypto-related companies already in the index, like Coinbase or Block?
That's the critical distinction. The committee generally wants companies with diversified, stable, predictable business operations. MicroStrategy's strategy, this extreme reliance on a single, highly volatile asset held on its balance sheet. It introduces a level of speculative risk that's just not typical for an S&P 500 company.
So Coinbase and Block are different how?
Their models are primarily service-based. Coinbase runs an exchange. Block offers payment services and some crypto functionality. They facilitate crypto activity or use blockchain technology, but they aren't primarily defined by holding massive amounts of Bitcoin as their core corporate strategy and asset.
That makes sense. It's a subtle but important difference in risk profile.
Profoundly significant, yes. It's about the nature of the business, not just exposure to the crypto space.
So this really puts the committee in a tough spot. This raises an important question.
Right.
Does a company with a massive market cap, one that clearly warrants inclusion based on size, get disqualified simply because of how it achieved that size, because of its unconventional, crypto-centric business model?
That's the fundamental question they're wrestling with. It really highlights the subjective judgment involved.
And analysts seem torn on this.
Completely split. You see some saying MSTR's potential inclusion is one of the most watched events, that it meets all criteria needed, except for this Bitcoin strategy, potentially scaring off the index committee.
While others just say flat out it's unlikely for now.
Exactly. Pointing directly to the volatility and those profitability challenges we discussed. The lack of consensus really underscores the committee's dilemma. It's not a straightforward call.
Okay, so we've laid out the hurdles, the reasons why not. Now let's flip it. Let's get into the what if. Here's where it gets really interesting. What actually happens if MicroStrategy does get added?
Right. The implications are pretty significant. We likely see what you call a new era of fund flows for this particular stock,
A new era, meaning?
meaning an immediate, almost automatic torrent of capital pouring into MSTR stock. This comes from all those passive index funds and ETFs we mentioned earlier.
Because they have to buy it to match the index.
Precisely. It's mandated buying. And this isn't just short-term speculative interest. It represents a new permanent source of demand for MicroStrategy shares. It's a structural shift in its investor base.
Wow. So trillions of dollars are benchmarked to the S&P 500.
Trillions. Think about retirement accounts, 401ks, pension funds, regular brokerage accounts holding S&P 500 index funds. If MSTR gets in, all those investors effectively gain exposure to Bitcoin via this proxy, whether they actively chose it or not.
That's a huge point. It would also pour fuel on what some people call the Bitcoin flywheel, right? Can you explain that concept?
Sure. The Bitcoin flywheel idea is pretty clever. MicroStrategy has been using its strong stock performance, partly driven by Bitcoin's rise to raise capital.
How? By issuing debt or more stock.
Exactly. They issue convertible bonds or new shares. Then they take that cash and do what? They buy more Bitcoin.
Which, if Bitcoin keeps rising, boosts their asset value and potentially their stock price even further.
Creating this virtuous cycle, or a flywheel, and has worked incredibly well for them so far. MSTR stock has generated something like an 80% annualized return since they started this strategy.
Which is even better than Bitcoin itself over that period.
Yeah, Bitcoin's return was closer to 60% annualized. So they've actually outperformed their underlying asset by effectively using their corporate structure as leverage.
So if S&P 500 inclusion happens, how does that turbocharge this flywheel, as you put it?
Well, inclusion would dramatically amplify that cycle. First, the sheer volume of mandated buying we discussed provides a strong base of support for the stock price. Second, being in the S&P 500 brings significantly increased liquidity and forces broader analyst coverage. This attracts a much wider pool of institutional investors who might have been hesitant before.
Making it easier for them to raise even more capital.
Exactly.
Right.
Easier and potentially cheaper capital, which they can then plow back into buying more Bitcoin, further spinning that flywheel. It's not just a one-time pop. It could become a long-term phenomenon, reinforcing their strategy. Studies generally show a permanent uplift in institutional ownership and liquidity after a company joins the index.
And this potential is magnified when you look at some of the, frankly, very bullish price targets some analysts have for Bitcoin itself.
Right. You see firms like ARK invest with projections that seem almost astronomical, $1.2 million to $2.4 million per Bitcoin by 2030, or a Standard Chartered predicting maybe $200,000 by the end of 2025, $500,000 within 3 years.
No, those are just projections, obviously.
Of course, highly speculative. But if Bitcoin does see significant appreciation, the effect on MSTR stock, given that tight correlation and the flywheel effect, could be magnified considerably. It raises the stakes of the committee's decision even higher.
Okay, let's connect this back to the listener. What are the practical, strategic implications here for different types of investors?
Good question. Let's start with passive investors, people holding those broad S&P 500 index funds. For you, this whole rebalancing process, not just with MSTR, but any addition or deletion, creates these subtle hidden costs.
Hidden costs? How?
When a company like MSTR is announced for inclusion, all those passive funds rush to buy it in that short window before the effective date. This concentrated buying pressure artificially inflates the price temporarily.
So the index funds end up buying high.
Often, yes, they're forced buyers at that inflated price. Conversely, when a stock is deleted, they're forced sellers, potentially driving the price down temporarily and selling low. It's a small drag, but over time, across many rebalances, it can add up.
So what's the takeaway for a passive investor? Just accept it.
Pretty much. The strategy for passive investing remains long-term commitment, diversification, and discipline. You accept these minor rebalancing costs as part of gaining that broad, low-cost market exposure. You're in it for the long haul, not trying to time these short-term effects.
Okay. What about active investors? Is there an opportunity here?
Potentially, yes. Because the mandated buying by passive funds is predictable, once an announcement is made, it creates a short-term arbitrage opportunity.
meaning you could buy the stock after the announcement but before the effective date, hoping to sell it to the index funds at that inflated price.
That's the idea. You try to front-run the index funds, essentially, but it requires very swift action. As we said, that window between announcement and effective date for the S&P 500 is typically really short, averaging just 5 days.
So high risk requires close attention.
Definitely. Not for everyone, and transaction costs can eat into profits. But the predictability of the flows does create that potential edge for those willing and able to act quickly.
Zooming out again, what broader market insights can we draw from watching situations like MicroStrategy and the S&P rebalancing?
I think it really underscores that the S&P 500 isn't some static, carved-in-stone list. It's constantly evolving. It's a process of continuous adaptation and even creative destruction.
Creative destruction.
Yeah, companies fall out, new ones come in. The fact that the market cap requirement keeps rising, the fact that the committee has to grapple with totally new business models like MSTRs, it shows the index is constantly trying to reinvent itself to accurately reflect the current economic landscape. It's a mirror, albeit a slightly delayed one, of where the economy is actually going.
That's a great point. It's not just what's big now, but what represents the leading edge.
Right. And if we connect this to the bigger picture, there's a fundamental paradox here. Getting into the S&P 500 feels like this huge validation, right? A sign that a company has truly made it.
Definitely seen that way.
But the actual price premium, that boost a stock gets from being added, research suggests it's often a temporary effect, linked mostly to that forced buying we discussed.
So the strong performance usually happens before inclusion, not because of it.
Largely, yes. The strong fundamentals, the growth, the market enthusiasm that gets a company considered for the index that's usually the main driver of its long-term success. Index membership is arguably more of a symptom of a company's existing strength rather than the cause of future strength.
Interesting distinction. Validation, but maybe not a magic bullet for future returns.
Exactly. It confirms success already achieved.
So what does this all mean then? Wrapping things up, MicroStrategy's situation seems like this perfect little case study, a microcosm of how these traditional market benchmarks are being, well, pushed and challenged by new ways of doing business.
It really is.
It highlights that tension perfectly, the hard numbers, the quantitative stuff like market cap, versus the squishier qualitative concerns like profitability, stability, and fundamentally, what kind of business are you really in?
Absolutely. It forces a reevaluation, which leads to a final thought, perhaps something for you, the listener, to mull over.
Okay, leave us with something to think about.
Consider this. How far can innovation and these really unconventional corporate strategies, like MicroStrategy's Bitcoin Treasury play, push the boundaries of traditional market benchmarks like the S&P 500? At what point does the very definition of a blue-chip company need to fundamentally change to keep up? And, maybe more importantly, what could that shift mean for how we all think about investing in the future?
Welcome to the Deep